My name is Richard Waddington. I've worked for 20 odd years in finance. I've always been involved in the mathematical side of finance. I graduated with a degree in physics. I worked in engineering before I worked in banking. And I've always been fascinated by the maths and the process behind finance. One of the things that I always found fascinating in finance relative to my experience as a scientist or as an engineer is the different emphasis of process, the emphasis on process. In engineering and manufacturing, process is the most important thing. There is room for some flair and artistry around elements of design, but when it comes down to making reproducible quality product, process is key. Process is king. When I look back over my time in finance, I can probably think of the maybe 1,000 people who I've known well enough to understand their business model. I can probably think of 4 or 5 who had a ego-free, emotion-free approach to the process of their decision-making. And I wasn't one of them, by the way. And when I left my final job in banking back in 2009, 2010, one of the things I spent a lot of time thinking about was how to improve these processes, how to help in decision-making process. What were the gaps in the skill set, certainly that I'd attained and that I saw around me, that could be filled with a better process? And that was probably the sparking point, the evolutionary starting point to Sherpa Fund's technology. If we think about the chain of action that happens in any investment decision, and we go from front to back, so we have a portfolio manager or an investor making an investment decision, they will generally have some process around how they make the decision to buy or sell an asset. It could be fundamental bottom-up analysis, it could be technical, it could be a combination of everything else, but they will have some process by which they gather data, they do analysis, at the end of which they decide buy or sell an asset, to go long, short, depending on all sorts of other stuff. And then if we jump a little bit further down the chain to the point of post-execution, once a trade has gone through execution, there is a whole plethora of processes in place, and people have spent a huge amount of money and effort building extremely efficient straight-through processing, data reconciliation, transmission protocols. This has been a massive area of what I call hardcore IT in this area. So you have the individual PM decision makers' processes for deciding upon buying and selling an asset, and then you have post-execution, the businesses, let's call it the business of asset management, industrial processes for post-trade management, for trade life cycle, for settling, accounting, regulatory reporting, all these things. And these are very big industries in and of themselves. But in between the two, there's a gap. And that gap comes from having made a decision to buy an asset to creating a portfolio which includes that asset. And that's actually an interesting, well, for us, a very interesting place. The processes required to do this correctly are to take account of all the correct inputs, to shield yourself from your biases and your ego, are pretty complicated. This is the area in which we live, this area post-decision to buy an asset, pre-decision of how much of that asset to buy. So the place where we create, the place where we help, the place where we add value to the process is in enabling a consistent process for converting an asset decision into a portfolio. The practical problem that the portfolio manager has to deal with every day is not as simple to describe. They're not trying to be on the efficient frontier. They are trying to be on a specific efficient frontier which describes the shape of their business. It describes if I put a metaphor, the box around which their business is built. Because when you speak to an asset manager, about long-term success. It comes from telling your investor what the box is and then performing as you've told them. So do what you say you're going to do on the tin. And that definition of what that box is quite complicated. So that's the first part of the problem. The second part of the problem is finding a solution which is the sort of mathematical part, and probably not for... We're happy to talk to anyone about that in great detail, but it would involve a couple of hours of sketching and diagrams. And then the third part is creating a solution that is stable, that actually is workable. One of the real issues with multivariate optimizers, and that's at the heart of any solution like this, is stability over time, stability with small changes to the inputs. Now, the reason I think, again, that we are unique is that I've been running multivariate optimizer-based businesses for 20-odd years. So I've learnt, at some expense, pretty much all the lessons that can be learnt about how these things operate. And our solution has incorporated all these problems. So that's a very long-winded answer to a very short question. Why is this not used? The answer is it's difficult. It's difficult to describe the problem. It's difficult to solve the problem, and it's difficult to make the problem, the solution, stable for the manager.
So I understand now there's a real need to address position sizing and have procedures for that middle part of the portfolio management task chain. But tell us in more detail, what are the real benefits of having that? Or the other way around, what do people miss if they don't follow a proper procedure here?
I guess what we're trying to get across here is the real benefit of using this technology and using this framework is ultimately it comes down to more consistent returns, so you get better returns. It gets more consistent communication, so you're able to appeal to a much wider investment base, and you've got better process. So in a transparent world, it's almost like the active managers are fighting back against the robo-traders. It retools active managers, it retools wealth managers to be able to provide an aligned interest to the end user. So that whole, encapsulating that into one consistent process, I think is incredibly powerful nowadays. And if I can just add as well, it obviously encourages a lot more trust, a lot more communication, a lot more understanding of the investment technique, and a lot more trust, which will then help ultimately raise AUM and increase the longevity of the business.
So yeah, so even with our very first two clients, we have addressed both issues. Raising money through creating a better narrative around your business and improving returns and actually improving the portfolio manager's day-to-day life existence, because you've taken a large headache out of his or her life.
It's also very important to mention that this is solvable to the very simple client as well. This is the small hedge fund, which makes it incredibly marketable. It also solves any problems for independent financial advisors or the private banking or wealth management space.
So Richard, how has the industry, how have portfolio managers actually taken up your product and your idea? What's their reaction?
It's always interesting when you go to somebody with an improvement idea in a field in which they are an expert. So it's very easy for somebody to take this the wrong way and see it as a challenge to how they work on things. But the reaction we've had, clearly there has been a small minority of people who feel that this undermines in some sense their own way of looking at the world. The vast majority of PMs we talk to see this as, let me call it life-affirming, making their life much, much easier. It's the one area of their world which they find sort of stressful without them wanting it to be stressful. So when we're in this business, we're all involved in stressful decisions of choosing things, choosing assets, doing analysis. and then we're subject to what happens in the future. So but that is the nature of the business. The areas that people don't particularly enjoy are when there's lack of clarity around the constraints under which they're operating, and after the fact being questioned around the results of the evolution of time. Giving a PM a framework in which all those questions are pre-asked and predetermined and pre-set out, and allowing that PM's expertise in the asset selection to be shaped by the parameters that have all been agreed with all the stakeholders, actually frees the PM from a huge burden and makes their life much, much easier. We have different levels of reaction at different levels in organizations. So when we talk to sort of CIO level in the very large funds, one thing we've heard multiple times is that they are looking for ways to empower their analysts. So, and empower really means allow an analyst to have his or her analysis converted into a revenue-generating pool of money. So, the difference between analysis and portfolios is that one has cash in it, which generates revenue, and one is just ideas, just bits of paper. By allowing analysis to be converted into portfolios without worrying about the analysts, without requiring the analyst to be a perfectly formed, mature and emotionless portfolio manager, is a way of empowering analyst groups and getting the most out of the value that they generate within an organization. So the large organizations that have pools of analysts see this as being a way of empowering that work that they are doing, the alpha that's being generated in the analysis report, and converting it into profitable portfolios. The smaller organizations where the PMs are really their own analysts in many senses see this as something that makes their life much easier. It forces all the decisions to be made ex ante. It forces everyone to be absolutely clear about what they're trying to achieve, what the constraints are, what the limits are, and then creates from the PM's decisions, creates the best portfolio that fits all those decisions, fits all those parameters. Yes, you could view it as a threat, but you'd be missing out on all the benefits of it. One phrase I like to use, people talk about AI, right, artificial intelligence. Now, I'm a physicist. I don't believe in artificial intelligence particularly, but IA, intelligence augmentation, is a huge topic, and this is absolutely about intelligence augmentation. We take a PM, we take somebody who has an expected positive sharp, an expected alpha, and we augment their decision making by providing frameworks for which all the extraneous factors are input and getting the best possible answer out of it. And we do it in a practical way.
So Richard, you called your company Sherpa Fund Technologies, and here I'm in your office and I'm looking at your website, and it looks like a pretty high mountain. What's the story with the mountains and the Sherpas here, please?
The inspiration behind this is really the difference between work and process. So in this picture, myself and my friend Dom here, we've done work climbing up this mountain, but the process has been guided by the chap who took this photo, a mountain guide, a friend of mine called Ensemble. We do work, but we needed the guidance of the guide to help us, right? He created the process under which our work achieved a result. Just, Dom and I climbing on our own would have probably fallen off and killed ourselves, but we definitely would have got lost in some way or another. Well, this is a metaphor for everything that we talk about in our business. Without process, work is sort of has random outcomes, but process can convert work into achievement.
So Richard, your product, the ORS, the optimal risk sizing, combines two perspectives. It's the perspective of the portfolio manager together with the perspective of the investor. But tell us now, how are these different and how do you combine them into one framework?
One of the hardest problems for fund managers is to incorporate all the various requirements from the various stakeholders in their actions. And one way of thinking about that is if we look at the way that a fund manager will look at the portfolio he or she has produced relative to the way that an investor, particularly an institutional investor, will look at that portfolio. This diagram talks this through. A fund manager typically will emphasize from the top down, will emphasize the asset selection process. We'll talk about the way that they have a unique method of doing their analysis at an asset-by-asset level, how they come up with their choices, with their convictions, then how they impose risk limits within it, their sort of exposure limits. And really only at the very end will they look at the sort of bigger picture factor or country or sector type exposures that the result of these asset-by-asset decisions create. From the other side, the investor point of view tends to start this way around. So looking at the factor exposures, the sector exposures. From the investor point of view, the investor has given money to fund managers, multiple fund managers typically, and will want to ensure that the factor and sector exposures across those fund managers are uncorrelated or unlinked. The investor is interested in the value the PM produces from his or her asset selection, because that is what generates the excess return, the thing they are paying for. But it's very important from the investor point of view that factor and sector exposures are not concentrated across multiple investments. So by providing a framework into which the PM can input their asset selection and at the same time input the factor, sector, gross exposure, risk limits, risk tolerances that all the other stakeholders require, ORS allows you to produce a portfolio that optimizes, that gives you the best possible returns given the whole combination of inputs, of parameters that all the stakeholders require.
So Richard, I'm sure you have done some studies and you can actually prove the effects of your work and the benefits it has on actual portfolios.
Naturally, we are data-driven people and, of course, come from a sort of scientific background, so data is everything to us. I think we can probably split the response to this into three different sections. What is the instantaneous effect of optimally risk sizing a portfolio? What does that look like is the first stage. The second stage is, what does that do to P&L over time? So what is the impact on P&L of having optimized things, because that takes time to follow through. And then the third thing, which we've probably talked about a bit before about, is what is the impact on your business of doing this? So if I start with the first part, what does an optimally sized portfolio look like? Well, I'll give you an example here. This is a real portfolio of actually 64 assets in a fund. The portfolio has many constraints around it based on what various stakeholders require, from the PM to the CIO to the investors, regarding gross and net exposure limits, country by country limits, sector limits, and even down to some factor limits, which makes it a very complicated portfolio to construct. The portfolio manager is a fundamental bottom-up analyst and is interested very much in picking assets that are going to perform versus assets that will underperform. When the portfolio manager creates his or her own portfolio, it tends to look like this. And actually, pretty much all portfolios we've seen tend to look like this left-hand graph. It shows that the weight of the portfolio on the y-axis tends to be bigger for assets that are more highly correlated, which is the x-axis, to the whole portfolio. And you can see this is sort of a dynamic problem, because if you change one of these assets weightings, it changes the whole portfolio and the whole correlation structure. So it is quite a complicated problem. But the end result typically of portfolios we've seen, pretty much every portfolio we have seen, is a portfolio where the highest weighted assets, the ones with the most conviction and the most weight, are the ones that are most correlated to the rest of the portfolio. Now, when we think about that in risk terms, that clearly implies quite a lot of concentration. It's clearly quite a large bet, in this case, on the assets that are sitting around here. The returns of this portfolio are much more likely to be generated by whatever happens to these assets than whatever happens to these assets. When we take the same portfolio, the same asset selections, we take the value of the portfolio manager's work in choosing assets, we take account of all the constraints that he or she has to deal with that reach as far as the investor's factor tolerance, and we say, okay, let's take account of, and also we look at the conviction of the portfolio manager per asset, and we optimally risk size it. We end up with a portfolio that looks like this. And the surprising things about this, well, first up, the most highly weighted assets are the ones which have the most negative correlation to the rest of the portfolio. The ones that are highly correlated to the portfolio have the lowest weights. This means that the overall returns of the portfolio, the returns generated by this portfolio, are evenly distributed across the returns from all the assets. If this asset performs, it means that pretty much all these other assets will perform too. So you'll get a kicker, even though you're lowly weighted in this asset, you get a kicker from all the rest of them. Whereas if this asset underperforms, it's negatively correlated to the rest of the portfolio, so it's not going to destroy your portfolio. This is a much more stable and much more balanced portfolio. The work you have done as a portfolio manager in selecting your assets, and you've selected, in this case, 64 assets, will be reflected in the returns of all 64 assets. Prior to using ORS, the work you have done in selecting these assets will be emphasized, and these ones will really count to nothing. The second thing I mentioned at the beginning was, so, okay, how does this play out over time? Well, I can show you a few more pictures like that. Here we have another fund returns. Over this period of time, and this is quite a short period, I think 5 or 6 months, the red line is the return of the fund over this period of time. So, over this short period of time, they did pretty well. They made like 5.5% or something. Taking the same asset decisions on the same day with the same execution prices, the same trading costs, everything exactly the same, and the same risk appetite, that's a key part, but optimally sized portfolio, you end up in this first light blue line. So you have an outperformance due just to what we just talked about previously, due to a better distribution of returns for the risk you're taking. It's important to note that this change in risk tolerance, change in riskiness that you are seeing clearly in these three lines is not a result of increased leverage. These 3 ORS plus the original portfolio, these 4 portfolios all have exactly the same leverage. They have the same net and gross exposure. They have the same net and gross exposure at country by country and sector by sector levels. The difference between them is that the higher risk portfolios, more of the weight in the higher volatility assets. It does not come from increased leverage, it comes from increased risk-taking with the same leverage. The third impact of optimally risk sizing a portfolio is on the business side. By allowing your investor or your own CXO level of the business to define exactly what it is you're trying to do in this portfolio, to define the exposures, to define the factor exposures, the limit structure, the risk tolerance, everything that you're trying to do in this portfolio, and then building a portfolio around that definition, suddenly you create a much more interactive narrative with your investors, one where you can demonstrate to them that you have a process for taking account of what it is they want to do in the portfolio. Sort of analogously, you're doing what you say you're going to do on the tin. You write what it is you're going to do on the tin. Maybe you do that yourself. Maybe you do it in combination with your investor. But you say, this is my tin. This is my business. This is what it is. And you write it explicitly outside the tin. The optimal risk sizing technology allows you to then run your business exactly in line with what you have written on the tin. And this is a very powerful differentiator in our business. We've already seen it in terms of clients of ours who have used this to raise money. It's a differentiator, and also it's actually makes your life a lot easier. Right? The worries over whether you are following what it is you said you were set out to do are taken away.
Richard, how has the product been received?
This product is truly unique. We're not aware of any other product that is focused in this way on the pre-trade decision-making process. A product that is driven and designed for PMs to use before there's any trading going on, in a way that it is not a post-trade analytical tool. It's not an attribution tool. It's something that allows you to form your portfolios based on all the constraints and all the inputs that all the stakeholders may have. We have a patent on it. There is nobody else out there producing decision-making tools that work in a pre-trade way that directly help the portfolio managers do the best possible thing they can do with their analysis, with the decision-making. And as we talk more and more about this product and as we bring it to market, we're seeing more and more people really understanding the strength both of our company and of our expertise in this sector. I mean, we are definitely solving a real problem, a real-world problem that exists across the whole spectrum of asset management, whether it's hedge funds, mutual funds, wealth managers, and even down to the level of retail trading. The reception across if we think of the sort of the four main levels we're talking about there, so hedge fund managers, long-only mutual fund type managers, wealth management, sort of retail type level, and then actually even technology providers, people who provide pipes and plumbings to fund managers, is all, of course, very positive. And the thing that attracts these users from all the spectrums to what we're doing is really the uniqueness of this product. The product is not a flash-in-the-pan concept that comes out of nowhere. I mean, Craig and I have experienced the downside of getting this part of your process wrong over many years in finance, personally and amongst people I've seen operating. This product is a real solution to a real problem. And where the uniqueness comes in is the fact that the solution we have built is one focused on usability and practical usability rather than a pure quantitative solution, something that lives, in the sort of back office or in the risk analysis world.